MER, Management Expense Ratio. What is it? Why should I worry about it? Well, what it is basically a fee that's charged to a fund. It's charged to a fund to manage the fund, to market the fund, pay commissions on the fund, things like that. So that's what it is. It's all the expenses related to operating the fund, from everything from turning the lights on in the building where they run the business out of, to basically having the guy clean the floors there as well. So it covers pretty much everything. But the management fee varies per fund, and it varies dramatically in some cases. So this is why you want to watch out for it, because it actually comes off of what profit you're going to make at the end of the year. So when you say a fund makes 10%, that fund minus the, say, 2% MER, that would mean that you would get 8%. You actually don't pay this MER out of your pocket. It doesn't need to come out of your account or anything like that. It comes straight out of the fund. You don't even see it happen. But the thing about it is, over the lifetime of your investment, this MER fee can have a dramatic effect on your growth of your wealth. So this is what we're going to get into. I'm going to show you a little bit. But first, we're going to walk through this chart. These are some of the MER expense ratios that can be associated with the fees that come with the MER. MER. So what is MER? So MER is a bunch of fees. So in these fees, it is basically a management fee. You can have a trailing commissions fee. You can have operating expenses. It'd be like hydro, gas, any taxes they have to pay, as well as marketing, as well as all the people's salary that are involved with the fund. The one big one is the profit. So again, these funds are businesses. They need to make a profit in order to keep their longevity, keep their businesses running and things like this. So they also have a profit. Depends on how much profit they want to make, could affect the MER dramatically. But that's what it is. So MER is basically all the expense related to the fund. So when choosing a fund, you also want to look at the MER to make sure it's as low as possible. The reason why is you want to make sure the funds run efficiently. They're not trading in the fund a lot. And this is going to affect what you end up getting in the long run. So this will dramatically affect your investments over the course of its lifetime if this MER is too high. So we're going to get into some charts. I'm going to show you what MERs look like. I'll show you some examples of MERs that are currently out there right now in some of the top performing funds. Okay, so let's get into a chart and we'll look at it and see how MER affects you over the lifetime of your investments. So MER, high MERs versus lower MERs, how it affects your growth of your wealth over your lifetime of investment. In some cases, it can have dramatic effect on your wealth over a lifetime of your investment. Even though it's a small percentage, the compounding interest that you're losing out on by paying these fees can actually equal a lot of money. So we'll start off with a small MER, which is like a 1.28, one I found online on the funds. I'll show you these funds and I'll show you some examples so you can see, and you can even do the research yourself. I'll show you the websites where I got the information from. So basically you do an MER of 1.28, and over the lifetime versus an MER, which is 0.9, which is VFV's MER, you'll see over the lifetime of investment, if you started when you were 20, over your lifetime of your investment, it'll be $774,000. Just over 30 years, it's $100,000. But this 1.12 is actually a low MER for mutual funds. A lot of the mutual funds I see are around 2%, even higher in Canada. So we'll do 2% and we'll see what that is. So 2% over the lifetime of your investments is almost $1.1 million. Over 30 years, it's $145,000 of lost revenue you lose out on by basically paying these fees at a higher percentage versus the low-cost index fund. VFV isn't the only low-cost index fund that you can invest in. BlackRock has one. A bunch of them have them. I'll throw up a couple examples of them, but there are lots of low-cost index funds. And when they speak about low-cost index funds, this is what they're relating to. They're relating to the management expense ratio. They're relating to these fees, and that's why they're considered low-cost index funds. It's because you're not paying all these fees for them. And these fees affect your investments over the long run. So I'm going to show you a couple of examples of some of these companies online. We'll take a look at them, and I'll show you some of the other low index funds that you can look at as well to invest in. Okay, Canada's most expensive funds. So I just went on to Morningstar. I just grabbed up Canada's most expensive funds in Canada, and it gave me 20. So there's 20 here. You can look on Morningstar yourself and see where it is. This is for 2023. And you can see some of these funds here are like 4.6%. Like, a fee like that would cost you probably $250,000 over 30 years is what you would lose out in that management fee that you would be paying on that money compounding over time. And that's the key. You're not just losing out on the fee portion of it, you're losing out on the power of that money compounding over time. So over 30 years, you would probably lose, say $250,000 over a lifetime, say of 45 years of investment, you'd lose like $1.2 million. And that is a significant amount of money to be giving up in fees. So, and then we'll look at here. So I have the most popular funds. So these are Canada's most popular funds. So these are a lot of index funds, and these are sold by the big banks for the most part of them. And you can see here the management expense ratios. Those are more reasonable. They're down a little bit, but yet still they're very high. So when you take something like, we'll go with the top one, which is 1.94. So if you punch 1.94 into the little Excel sheet we have, so which is right here, 1.94 over the course of your lifetime of investment, if you started when you're 30, is over $1 million. Just in 30 years of that time, that's $140,000. It's a difference of you having $300,000 or $440,000 in your portfolio. To me, that's a significant difference. Like the power of that money compounding over time is what you're losing out on. So having low MERs is very important, and it's a very important thing to look at over time. The lowest ones that I've found so far have been the VFV, Vanguard, BlackRock, and actually TD has a very low index fund. They don't even advertise it. If you went into the bank, they would probably never sell you it. It's 0.07, which is actually lower than Vanguard's. And they probably offer it just to stay competitive. The return on the fund isn't as good. It's supposed to be an index fund, but in an index fund, even if it's an S&P 500, so we'll use that for an example, BlackRock and Vanguard's, they look very similar to the holdings that are in the fund. But when you throw the TD one in, the TD one has different holdings. So it has a higher percentage of tech stock, lower percent of hardcore industries, lower percent of real estate, or higher percents of this, that, but it doesn't match up with the other two. Hence why that fund doesn't seem to be performing as well. But that's diving a little more deeper into it. It still does perform good, and it is a low cost index fund. So I got to give them that. They've come up with a very low cost index fund. If you want to invest with TD and you want to invest in one of their funds, that would be a great option. I'll throw those up here at the end so you can see a couple of those funds and you can do your own research on them. But that's kind of how all this works. So that's what the MER is. So that's it. That's MER in a nutshell. Basic understanding of MER, how it works, how it affects your investment over your lifetime of investing. This can have a dramatic effect on your investments in some cases. So it's something that you want to look out for. So right here is some of the index funds that I was talking about, not endorsing these funds in any way, just using them as examples because they are low cost index funds. And these are some of the things that you want to consider when you're looking to invest in funds. Okay, hope this helps you out. Please subscribe, follow, and I'll keep posting some of these videos and hoping to help people out.